Hi, everyone. Welcome to Ask the Planman. Everything you want to know about insurance, finance, and more, but we're afraid to ask. I'm your host, Bruce Weinstein, and today I have the pleasure of being joined by Senior Vice President of Herman Sons Life, my dear friend, Robin Czarnek. Robin, thank you so much for being with us today. I want to get into why do people need life insurance?
Oh my goodness, there are so many reasons why, but thank you for having me, Bruce. And this is an important question that people need to think about. What are the reasons they need to buy life insurance? I mean, probably the main reason people think about is debt, right? Your mortgage, your credit cards, your car payments, and things like that. I mean, that's probably the top of the list. For me, it could even be deeper than that, though. You know, what are the other things that people want to have life insurance for, right?
Absolutely. So what I'd like to do for the audience, we always like to give them the so whats, is I want to, with your assistance, break down the types of insurances that are out there, because we're always asked, like, well, should I buy term? What's permanent? What's the difference between whole life and universal life and all of that? So and then let's tie that in to some of the strategies where the different insurances might be better utilized versus others. You're doing this a long time. I'm doing it a long time. And so the key here, folks, is everybody's scenarios are different. It's not one size fits all. You don't just put on a big schmata and walk around in a big, hoop skirt. You want it to be custom tailored. So you mentioned debt and those obligations. So fundamentally, when a couple gets their first mortgage and start a family is when people start to entertain having that life insurance. Home values have gone up tremendously now. People are taking out, or at least we're taking out, some pretty substantial mortgages. And so God forbid something happened to your spouse, to my spouse, to me, we would want to make sure that they don't lose the home because they've lost the income from that spouse, or they can no longer pay the mortgage. And so having enough life insurance for that purpose. So you said so debts, mortgage debts, and then if you had young children, where would you be applying life insurance for a young family with children? What would go into that?
Well, there would be several things. First off, income replacement, right? If it's the breadwinner or breadwinners, whatever the situation is, you got to replace that income. But it could even be a stay-at-home parent, and I think that's one of the things that's often overlooked. A stay-at-home parent is still filling a role. They're the daycare, they're taking care of the kids, they're taking the kids to school, they're cooking meals, cleaning, whatever it is. So you have to replace that labor somehow. And most parents, if you're a single parent household and maybe you're the only breadwinner now, you've got to figure out who's going to take care of all those roles. So I think that's often an overlooked one. Another thing would be college education. Do you want your child's 2 years old now, and God forbid a parent passes away? Are you going to want that child to have an education fund? So that's another thing that life insurance can fund for those children.
In the world of planning, Ask the Planman, we're all about people having a plan, whether it's a college plan, a retirement plan, a business plan. So as you're hitting that one on the head here, college planning, not too many people have $50,000, $100,000 to sock away for a kid's educational need. We tend to save on the go, meaning out of cash flow. Over the 18-year period, we put money away for the kids. If that income is lost due to one of those two spouses/parents' untimely demise, that revenue is stopped, the ability to save the money has ended abruptly, and so now how are you going to pay for college? So that is a big piece of what we help calculate is the mortgage. And then I remember years back, I spoke with a young couple. They just had their first child, and we were doing their life insurance analysis. And I said, if your kid got into Harvard, would you want them to go? And they're like, yes, of course. I said, now, do you want to save for a Harvard education? Well, no, they didn't necessarily want to put away $250,000. But if something happened to them, they would want to have the $250,000 available. So what they were saving didn't necessarily correlate to what they wanted on the insurance because they weren't really prepared to pay for an Ivy League school out of savings. But God forbid one of them wasn't around, here's a lump sum for a little bit more money on their premium. We bumped up, an extra $500,000 for the two kids of the life insurance and made sure it was there. Unfortunately, nothing happened. So we've got the mortgage, we've got the kids, we have the college planning protection to put that money in place. And then you said something else is the stay-at-home parent. You and I grew up in a different era than our clients and our children have grown up on. And that is, mom stayed home and dad worked. And so you always wanted to make sure that the dad in the traditional scenario, again, certainly that's changed today, is protected and had the life insurance because mom didn't necessarily have the ability to go work, especially in the 50s and 60s and 70s. They didn't have the ability to go make that income that dad was bringing in. The opportunities for women weren't as readily available, and right. So that, and then as time later went on, where it became dual income families, and now mom's making as much as dad, if not more. Well, now all of a sudden we've got to replace her income just as much because the household is used to that dual income. True? And so it has morphed itself over time. And I want to go back. I was missing the point on the piece where the stay-at-home parent was not deemed to be as valuable or concerning. And I would hear that a lot from the gentlemen who were working of like, my wife stays home, I don't need insurance on her. And I would say to them point blank, are you going to give up your job and stay home with the kids? Are you going to be running them to Sunday school and preschool and nursery school? And where's all that money going to come from if you've got to put them in a full-time after-school program?
Exactly.
And I'm sorry.
No, I was going to say, and let's say they're an executive, where they do travel, they work long hours. I mean, now you're probably going to have a nanny or something like that. I mean, you're going to have somebody to take care of those tasks. And it's not always reasonable to say, oh, I'll just do it myself. Well, that's not always an option.
No. And like you said, if it's an executive that has demands to make that kind of income or is traveling, as you mentioned, you can't just throw that away and stop doing it without fearing you're going to be jeopardizing your job.
Right.
So you have to be financially positioned for the emergency what if scenario. And then the emotional piece of this is your children just lost their parent. They just lost their mother in this scenario. And so you're just going to suddenly not be around so much. Like where's the emotional support for your grieving children going to come from if you're back on the road flying overseas every week and the kids are stuck with the nanny and never see you? So again, maybe I'm sounding a little too judgmental on how people raise their kids, but it certainly for us, we're looking at it from the fiduciary responsibility to our clients and our clients' children to make sure that they are buffered and protected as much as possible.
Exactly. And it's important, like you mentioned, to work with a plan and to get to the heart of what they want. Because, there are parents who say, no, I want my kid to go to college anywhere they want to. And another one's like, hey, nobody paid for my college, so we have to get to the heart of what those clients want. What is important to you? Is paying off the mortgage important? Is leaving a legacy important? What do you want from this? And that's how we have to build that plan and then figure out how to fill those gaps.
Well, it's funny. You say, what do you want? So that's an acronym I use is called Woody Woofy. What do you want for yourself? And so when you're talking about people and their planning, most people have limited resources and they've got to make decisions and they have to prioritize where the dollars are going. Now, that said, as an example for the audience here, we just purchased for a 29-year-old mother of three $1 million of life insurance that was barely $35 a month. So we're not talking about spending thousands of dollars a month and crippling your cash flow. What younger people don't understand is the necessity of getting it. Term insurance is super inexpensive when you're young and very, very affordable. And to say I could put $1 million in place for $420 a year, it shouldn't be breaking most people's banks. And the upside of having $1 million on both spouses to protect their kids is paramount.
Well, and when you think about it, $35 typically doesn't change any household's budget. It's a minimal. I mean, you can't even go out to dinner for that hardly anymore. maybe Chick-fil-A or McDonald's or something. But as far as the $1 million, what that can do for the family can't be replaced. I mean, that's just, you've changed the trajectory of somebody's life by having that in place. The last thing you want is your spouse to not have that time to catch their breath, not have to sell everything you own because they can't afford to put food on the table, especially if you have kids. And God forbid, like in a lot of situations, what if it is a stay-at-home mom and dad didn't have life insurance in place? So the plan is either A, don't die, or B, now she's got to get remarried just so that she can feed the kids. And I mean, that's not much of a plan. You want to work with a reasonable plan.
We say it over and over on the show is we are here to be proactive, not reactive. And as you just described, that's reactive. It's like, oh boy, oh crap, look what just happened. Now what do I do? Versus if we're proactive, we're planning, you're sitting down with professionals like Rob and myself or somebody else, is you're having those conversations, you're thinking about the what if scenarios, and you're preparing and planning. And all of it is about information and decision making and then prioritizing. And so, as you just said, for $35 a month, you can't even go out, to McDonald's these days. So maybe it's one meal a month, maybe it's 2 meals a month that you forego going out, and have bologna and cheese sandwiches or macaroni and cheese. I mean, I ate all that as a kid. I mean, we weren't feasting at lobster. What's the Red Lobster as kids? Like nobody had that kind of money back then. So you have to make those decisions. And then I want to just make an emphasis on this younger client. Yeah, age is on her side, but everybody needs to understand that life insurance, you have to be insurable. And unfortunately, when people wait too long and something happens where they have an adverse diagnosis or an incident occur, trauma on their body from an accident, all of a sudden you're not insurable anymore. And that's where you really try and get the message to people is like, look, I understand you may need X, Y, and Z, and you want to have that car, and you want to take this vacation, but you need to prepare for this stuff now as young as possible. If your wife's pregnant, you should be looking at life insurance now, not 6 months after the baby comes, right? So that's procrastination. So you're not being proactive if you're waiting. So as soon as you get that mortgage, you are in a marital situation, especially where debts and liabilities have now incurred on a family basis, meaning 2 people or more, and now a family is in the growing stage, you need to get that assessed and get it plugged in, right? Plug it in.
Well, and I'm a prime example of that, Bruce, because my dad died of a heart attack young, and I'm not going to say he lived healthy. He didn't. But in his case, in his 20s, he became uninsurable due to first off diabetes, all sorts of health issues. And ironically, they had purchased like a $25,000 life policy at the company I happen to be a vice president of now. So small world, but that was the only life insurance he ever had because he couldn't qualify. And so that's to your point, while you're insurable and while you're young. So thank God he did have that because it was something, but clearly it didn't put my mom in a good situation, not having a whole lot. Now, and there was a letter that he wrote to my mom that he had put in the safe and said, I'm sorry that I couldn't get more, I mean, he and me being in the profession for almost 34 years, I couldn't sell my own father life insurance because he didn't qualify. And had somebody, I mean, $25,000 in the 70s sounded like a lot of money, but now.
It was a year's income. That was a year's income. Right.
Yeah. So, but my dad actually had an envelope of cash that he had put in the, like in their garage. He'd saved it in a shop. We had to really hunt to find it, but it was $11,000, which is a lot of money. But you and I both know that doesn't go very far. And, but I mean,
less today than in the 70s, for sure.
Yeah. Well, and I mean, this was just, he died in 2008. So, it wasn't a whole heck of a lot of money, but I mean, it paid for his services and then, a little extra, but that was all he could do, and so it just reiterates your point, you've got to get it while you're young and healthy and insurable.
The concern I always have in dealing with people and society in general is apathy. It's not going to happen to me. It's going to happen to somebody else, and the procrastination and I'm not worried about it now. And, I'll deal with it later. And the best opportunities as a professional are with people who've experienced something as you've just described. Because I bet the first thing you did when that started to happen is you made sure your personal affairs were better taken care of. You had a husband, you had children, right? So because of that lesson, hard lesson that your dad unfortunately was dealt his hand and couldn't do, better for your mom's protection, is it makes you elevate your game to make sure you're in better stead. And so that's, in my world of insurance over the years, anybody that dealt with, I had an aunt that went through long-term care in a nursing home, and I don't want that to happen to me and my kids. Like, they're going to sign up for long-term care. They just want to know where to sign. Like, there's not a lot of convincing and educating because they've experienced the pain, and we are trying to absolve the pain as advisors for them. And so life insurance, until, something unfortunate happens, most people have their blinders on and they're just apathetic to the need, and then crisis hits. And I can't tell you how many times I see somebody writing on Facebook with the GoFundMe pages, or I just got a diagnosis of, how do I get insurance now? Sorry, like that diagnosis just disqualified you. All bets are off. One of our episodes is on health and wellness and how to take care of your body better, and how your health and wellness influences your premiums on life insurance and health insurance and qualifying for these things. So, we're trying to put a puzzle together for everybody with our episodes here of how all these things go together and what you need to do to be better served and proactive with these things, and not keep your head in the sand like an ostrich. So all right. So we've got, I'm recapping one more time to make sure we hit them all. So we have the mortgages, we've got the kids, we got the income protection for the spouses that are gone, or the parent that's gone. And then, do we say college? So we had college. And then, how about retirement planning? And I have an A and a B on that, but you go first, and then I'll fill in. So,
retirement planning is kind of multifaceted because it depends on what the situation is, right? But you could certainly build cash value in that life plan. Now, it's not going to fund your retirement, but it can help supplement it. Or, if it's again, a stay-at-home wife, stay-at-home husband, or whatever, perhaps, they don't have any retirement, but that life insurance could be their retirement. What are you thinking? What are your thoughts on that as far as?
So I have two paths on that answer. One where you're going is the same thing as if the breadwinner is lost. They were funding a retirement plan at work, probably something like a 401k, or they were getting a pension accrued in their job, and now that's going to come to an abrupt halt. But it's the same piece of my comments before, where we're a savings machine in progress. We don't just wake up with $1 million and say, here you go, put that away now, and I never have to save another dollar. It's earn a living, create a lifestyle, and save. And as people say, pay yourself first. So if that income is, let's say you had two working spouses, and you're able to take one of their incomes and literally save it towards everything you needed. It paid the college savings, it paid the retirement savings, and you never really spent that money, but that's what you saved with. And now that spouse is gone. So the first spouse is still paying the bills, but you've just lost the second income stream that was doing all the savings. So where is that savings going to come from? The surviving parent's not going to be able to go double up their income in all likelihood, right? So part of the calculation would then be, well, how much did the surviving spouse need to be funding in a lump sum, i.e. death benefit life insurance, to catch up and fill that void that the retirement savings is going to be neglected now that they lost that income. Does that make sense?
Yeah, absolutely.
Okay. So that was A, and that's where you were tying in. But B is, and this goes back to the beginning of the types of insurance you use. One of the biggest tools we use with clients, mostly self-employed, people with some discretionary income that they could put more money away, they're not working at a job with a pension, is we create private pensions using life insurance because it's a tax-deferred vehicle. And now, in essence, you're killing two birds with one stone. You're protecting the family with life insurance, and at the same time, you're accruing some assets for retirement that can create a tax-free retirement income. And we're not going to get into the mechanics of that. We could certainly talk to anybody interested offline. But the way life insurance is used at a very high level with high income earners per se is, or self-employeds really, is to create a private pension for them. So that's, I say retirement kind of has two pieces. So, all right, what else you got? What's next?
I kind of just jotted down some quick notes, but I mean, for me, leaving a legacy would be important. And that could be in the form of leaving a legacy for your grandchildren, leaving it a legacy to maybe a charity that's important to you, maybe a humane shelter or hospice or something that's near and dear to your heart. And everybody's different with what drives them. I know both you're Robin and me, we both, we have such a heart for shelters and animals. And of course you do too. I mean, having a heart for animals and stuff like that. I mean, for me, that would be something that would be meaningful to me, would be to leave money for that. Or even my own Herman Sons where I work, we're not for profit. So, we have a camp that we fund. We have different programs that we fund. So any of that type of stuff, if somebody has something that's near and dear to their heart.
That's giving back.
It's a way to give back, especially if an organization has helped you, like a hospice or whatever it is, So
there's a couple of things with that, because to me it ties in with estate planning. Is that life insurance is a huge mechanism to create estate planning liquidity, again based upon the tax codes and where we are at any point in time in history. There's only so much money that you can protect and avoid inheritance taxation on, and then life insurance is used to create that liquidity. So if Robin and her family were very big into real estate or farmland, well, the farmlands that I've got a friend back in New Jersey that I grew up with, his family was one of the original settlers. Like a couple years ago, they celebrated 300 years in the community. This is New Jersey, right? I mean, this is Princeton, this is the area where like the early settlers were, pre-Revolutionary War. And so the family name goes back over 300 years. So if they had all this property, and what is that, 15 generations? I don't even know how to do the math, right?
I don't know. Yeah, well, and it varies, so.
So how does that land, in this example, get passed from generation to generation to generation without having to be carved up and sliced up? And part of it has to do with the estate planning, and in a lot of cases, creating liquidity using life insurance and life insurance trusts, so that if they've got a $5 million, $10 million farm that's going to have $3 million of inheritance tax due, well, what are you going to do? You're going to sell off some of the land? Or here's the life insurance proceeds now when I need it to pay the tax so the family can keep it. So that's a higher level piece of the estate. Now, to your piece with the charitable giving is people can use their assets in certain directions. They could do gifting. But what a lot of religious organizations do is, you know the word tithing, right? So people tithe, and they tithe while they're alive. They go and put something in the collection plate. Being Jewish, the High Holy Days, you're supposed to be making, your annual gift to the synagogue. And, maybe where, you're used to like every Sunday they're passing the plate and people put money in that way. So everybody's got some different orders of how they do it. But one of the things that we used to talk with people about is, look, if you're gifting every year $1,000, $2,000, $100, whatever it is, what if we took that donation and we bought a life insurance policy that would be gifted to the organization, the church, the synagogue, the order of what you want, the Children's Hospital, the American, Cancer Society, whatever, it doesn't matter what it is, but now that's leverage. Because for $1,000, maybe you could have gotten a $50,000 life insurance policy or a $100,000 life insurance policy. And statistically, you're not going to be putting that in for 100 years to make it up. To that regard of Robin's point is, if you have some charitable inclinations, you can leverage that with some life insurance. And instead of coming up with a bigger chunk of money, it could be in smaller increments. So,
And when you're talking about that too, like say that $1,000, well, maybe it's a $50,000 life policy that can grow if you get a vehicle that's the right product. It can gain more cash value. So now you're using the time value of money, for that charitable organization to make it grow even bigger, right? So that's a big one too. And you hit on the estate planning. Like I was thinking of, estate taxes are huge, and how often do you see the children, children's children of farmers, where this big, huge farmland is now cut and cut and cut because they have to, pay the property taxes, pay the estate taxes, all these different kinds of things. So, and it's tragic when you see that, especially if you have a family that's had this property for hundreds of years, and probably has buildings on there that their, forefathers built. I mean, that would be terrible. And to your point earlier too, like you see so many GoFundMes, and barbecue plate sales or whatever, whatever region you're in, whatever is common. But, it's heartbreaking to see that because, just with, like you said, $35 a month, it could have made all the difference to somebody stressing or not. Something that I saw too, that I was thinking about was like key man insurance, like a business partner. So you can buy out a business partner. I mean, because, okay, maybe you and I are in business, but maybe you don't like my husband, Dave. Maybe he's, you didn't have any intention to go into business with me or with him. Well, now you are if I kick the bucket. So
let me just clarify that a little bit for you and I know the term. So let me just bring it to more of a layman's. So key man or key person could be tied to a buy-sell agreement. So Robin and I are in business together. We each own 50% of the business. We manufacture water bottles, right? And the company's worth $20 million, and Robin and I each have a $10 million stake in that company. I now die. My wife is inheriting my business, right? It's her asset at this point. And now all of a sudden, my wife and Robin are partners, whether they like each other, knew each other or not. And then maybe my wife has no business acumen nor desire to run and own the business with we messed it up. We said two Robins now. So Robin I and Robin Y, for those that don't know. So my Robin is with a Y. Our Robin on the show today is with an I. So Robin with the I has a life insurance policy on her partner, Bruce, called a key man, key person life policy tied to the buy-sell agreement, which is basically giving the liquidity, we're back to that L word, liquidity, to write my wife or my children, my heirs, whomever's there at the time, the $10 million so she can receive the rest of the outstanding shares of the company and be in full control. And so that is a tool. Now, we just did one literally the last month or so where the owner of the company took out a $2 million key man policy on himself because of his financing and funding, where he's bringing in investors to help expand the business. And so tied to that is the business has a $2 million key man. It's not going to anybody else. It's going to the business to pay back the investors if the lead dog, right, the owner of the business who's driving the growth is suddenly gone. Well, the investors are like, well, shoot, the business just died, didn't it? The business is gone. Robin's not showing up anymore, right? So now it's a way to pay back the investors. So the key man can be used in some different components. It's good for partners and buy-sells, but it's also leveraged to pay back shareholders and investors that are, they're not managerial. They're not owner in the company per se as far as running it, but they've invested in it and they need their money back. You got to give them some guarantee. And so that's a way to do that. And so this, and a young gentleman, in his 30s, so it wasn't super expensive, but had to have it, and it has to be done a certain way. So I'm glad you brought that one up, because that's a good one. I tend to leave off the list. Any more on your list?
Something that I was thinking of, which is really not, it's a component of life insurance, but to me, it's one of the most important parts, is accelerated death benefit. And I don't think that's talked about a whole lot, but, God forbid, but you or I get, we have a terminal illness. I get diagnosed with a terminal illness. I'm going to want to take care of some things before I leave my family, whether that be not leaving them with a bunch of debt. Maybe I want to go for some experimental treatments. Maybe I want to go on a final vacation to make some final memories with them. Whatever the case may be, that accelerated death benefit. And for those that don't know what accelerated death benefit is, it allows you to have access to some of that life insurance before you pass away. You just have to have whatever the criteria set forth from that insurance company is. Maybe it's a doctor's note or, 2 doctor's notes or whatever the situation is.
It's usually sorry, it's usually a point where you're getting some kind of terminal diagnosis, right? So the acceleration is basically like doctors are saying 6 to 12 months, maybe under 2 years. And as such, it's inevitable that they're going to be paying the death benefit. It's not a type of life insurance. It's a feature on the life insurance, whether it's term or permanent, is a lot of them are built in already to have an accelerated death benefit, or you would certainly seek one that does. But it also added another one to the list if you don't have it, is now we're seeing long-term care insurance. The nursing home side is now these hybrid products have been created because of the chaotic state of long-term care, where it's tied to life insurance. Because a lot of long-term care, we're going to do a separate show on long-term care, is long-term care is for the nursing home, the assisted living, the home health care, proxy when people are older or diminished in capacity, Alzheimer's, Parkinson's, whatever, or just elderly and they can't take care of themselves. And so the insurance for long-term care has gotten very, very expensive, and the insurance companies don't want to do standalone long-term care as much. And they've created a hybrid product using life insurance where Robin would buy a $500,000 policy and it would give her $10,000 a month for 50 months when the time came towards a long-term care situation. And that in the context of your accelerated death benefit is an accelerated long-term care benefit. Is people have an illness now that is requiring the care. Now, the benefit to the person owning it and the family is, regardless of what happens, I don't know if I'm going to die before I'm 80 or I'm going to need a nursing home after I'm 80. I don't know what's going to happen. My cards have been dealt and I wait to see what happens. So the beauty of the hybrid product is somebody's getting the money. If you use the long-term care, well, then great. That's why I had it. And they'll pay you the $10,000 a month until it's exhausted. But if you never need it or you only use part of it, let's say I used it for 20 months, well, the family still has $300,000 coming to them for the life insurance. So the hybrid product is basically giving that flexibility of it could be for long-term care, but it's also tied to life insurance. And that is in the context of your accelerated benefit. Go ahead.
And the long-term care component too, that, like you said, that's kind of an up-and-coming endorsement, the writer that we're seeing a whole lot. Or seeing more and more, I should say. But I think when people hear that too, if they have not experienced somebody who's had to be in care, $10,000 sounds like an insane amount of money, right? But when you need specialized care for like Alzheimer's or some sort of dementia, or any sort of chronic illness where it just takes a ton of care, $10,000 becomes, absolutely essential. So I don't think people realize that how expensive, because, they think of it in terms of food and maybe a amount of a house payment, but it's far more than that because you're paying for those specialists to come in and take care of your loved one in the right manner and keep them safe.
At the beginning, we kind of said we'll talk a little bit about term versus permanent. So let's just spend a couple minutes on that. So the way I kind of frame this for clients is term is like renting. You're renting your insurance just like you rented your apartment. Maybe a security deposit, not to get into the weeds with that. But when you leave your apartment, you're just leaving. There's nothing coming back to you except that security deposit. And so term insurance is like renting your life insurance. If the crisis occurred and somebody died during that 20-year term window, the family's going to get paid. But on year 20 and 1 day, my policy expires July 1st, I'm no longer insured. I outlived it, and now I don't have that coverage anymore. And there's nothing recaptured in the essence of term insurance in that regard. Permanent insurance, whole life, by definition, is supposed to last your whole life. You're not gonna outlive the insurance. It's not going to expire as long as you're making your payments. There's enough cash value in the plan. So at some point in time, the cash value is growing, and now offsetting the death benefit and replacing it with the cash. So if you had $1 million policy with $500,000 of cash value, well, you really only have $500,000 of life insurance and you have $500,000 of cash. The death benefit is the two pieces, but you could pull that $500,000 out. It's your money, but then what's going to happen to the policy? So it's a savings tool. It's a savings mechanism. And then in between that is what became the competitor to a whole life policy is universal life, index universal life, guaranteed universal life. So they all have those different facets. But the key message, again, we're not going to get in the weeds on all the nuances. You could speak to your advisor, you could speak to Robin and myself more on specific. But the point of having permanent insurance is understanding and being proactive. I need this forever. I can't fund an insurance trust on my $30 million farm with term insurance in fear that it could eventually get outlived and now the liquidity's lost. It's got to be a permanent insurance solution, whether it's whole life, universal, or what have you. And so those are your differences. And let's be clear so people understand, term is way less expensive than getting permanent. And that's where the conversation then falls off of, well, what can you afford? What should you have? What are your needs? And what most people do, and you've experienced and done, is you blend it. You take some of this and you take some of that.
Mm-hmm. And that's exactly what I've done, and I'm sure you do too. For those short-term needs, you buy the term insurance for something that is a specified period. It's going to go away, then so the life insurance can go away. But for those things that matter to you, whether it's, you want to leave a legacy, you want to make sure that your spouse is taken care of for the rest of their life, your college education, whatever it is that, that goes on forever. That's when you want a whole life, a universal life, an indexed life, whatever the product is. And that's why they do need to get with somebody like myself or you, Bruce, to make sure that, that whatever product that we put you in, or products, like you said, a blend of them is often the situation that is going to suit your particular circumstances and make your wishes come true, because it's not about what we want. It's about making what plan they've put together, to get it a viable plan, right? Make sure that it's something that's workable.
Absolutely. Absolutely. It goes back to being proactive. It goes back to why we're doing the show. Ask the Plan Man. Everybody deserves a plan. If you don't have one, you got to get one. There's so many different ways to concoct a plan, if you use that word, and so many different meanings of plan for every situation. So again, college plan, retirement plan, estate plan, a business plan, a marketing plan, like plan. And the whole point of anything to do with the word plan is to be proactive, and that's what we're here to promote. So with that, Robin, I'd like to thank you for joining us today and sharing some wisdom with everybody on the various reasons why we need life insurance and the differences between permanent and temporary or term insurance. So thank you for being with us today. And I'd like to remind our listeners to please like, subscribe, share our podcast. If you or somebody you know needs to deal with these life insurance needs, reach out to your professional, go find a professional. Robin's contact information is going to be in the show notes. You can always reach us here at asktheplanman.com. You can email me personally at bruce@asktheplanman. Call our toll-free number, 844-PLANMAN. Thanks for joining us, Robin. Again, thank you for being here. Remember, folks, when you need some advice, always get it right. Come ask the Plan Man. Everybody needs a plan in life. Make sure your plan is punch-in-the-face proof. That's the old Mike Tyson saying, everybody has a plan till they're punched in the face. So make sure your plan is punch-in-the-face proof. Robin, again, thank you so much.
Thank you for having me, Bruce.
Absolutely, our pleasure.
When you need some advice, never sacrifice, always get it right. Ask the Plan Man. Finance, insurance, and more.